Markets have rebounded sharply from their March lows, and in Q3, some of those markets actually hit new all-time highs, which is remarkable given that we're still in a global pandemic. Now, as the quarters come to a close, we have seen higher volatility and market weakness. Both the S&P 500 and the Nasdaq had a negative return in September, which is quite different than what we were witnessing over the past few months. Now, maybe these negative returns may not be too surprising after all, given we've just seen the President of the United States contract COVID, and around the world we're seeing more and more cases. We also have an election around the corner, and the jobs numbers more recently have been a little bit less pleasing. Now the question is this a short-term pullback or something more severe? I think it's still too early to tell, but there's no doubt that we're going to see higher volatility in the coming months. Recently, the Federal Reserve changed its inflation target from 2% to on average 2%. Now that may not seem like a big deal, but it actually is. Given that we've seen inflation remain below 2% now for the last few years, it means that when eventually inflation starts to rise and gets past that 2% level, it can stay there for an extended period of time before the Federal Reserve has to take action. That means interest rates stay lower for much longer. And actually, the Federal Reserve even came out and said that they're likely going to keep interest rates near zero for at least until 2023. Now that has big implications to markets. On the equity side, it could potentially mean higher returns given the cost of capital remain relatively low. And on the bond front, it means that yields will remain relatively low for an extended period of time. Now, it's been rumored for months that a fiscal stimulus package was around the corner, yet we haven't seen one as of yet. The main reason for the delay is the difference of opinions between the Democrats and the Republicans, both in terms of the actual size of the package and the targeted areas of which the package should be focused on. Now, as we get closer and closer to the election, the chance of having a stimulus package becomes slimmer and slimmer. And the main reason is that neither one of the two sides want to give the other an edge. Now, if a stimulus package were to come, and if it targeted the right areas and had the right magnitude towards it, it could cause markets to surge like we've seen in the previous stimulus packages earlier this year. With 1 month away before the presidential election, it's important to understand, what would a Biden victory mean to markets. Now, Vice President Biden has actually been gaining votes as we look at the more recent polls. But it's not just what happens with the Biden victory, but what happens with the Democrats within the House and the Senate as well. So as an example, a victory on the House and Senate by the Democrats, which we would consider a blue wave, would be very positive for the Democratic situation. It would allow the policies that Biden wants to put forward to be easily passed and implemented through. Now that means that things like corporate tax as well as capital gains taxes would have no problem passing through. Unfortunately, those are things that markets would not really appreciate. And so we could potentially see that a blue wave would mean a retraction in markets. On the other hand, if we were to get a split House and Senate, that might cause a bit of a gridlock on some of the important factors or policies, but it potentially would cause a delay in some of those other policies that the markets did not like to take some time before they got implemented, or maybe not even getting implemented over time. So there's a possibility that a split Senate and House might actually be better for markets than one by a blue wave. Now, of course, that's not always true. If you go back to 2016, when President Trump won the election, it was supposed to be bad for markets. But we actually saw quite a different story. Markets actually reacted very positively over the past 4 years. So as all I can tell you is that in the world of politics or markets, nothing is ever certain. Recently, we found out that the President of the United States contracted the COVID-19 virus. And a few days later, we found out a few other members of the White House staff also contracted the virus. Now, how should the markets react to that? Well, initially on the news, the markets did sell off. But as we started to get more information from the doctors that were monitoring President Trump, and when they started to give us that prognosis that things were actually looking a little bit more optimistic, and the fact that he actually left the medical center, well, that was all great positive news, and markets actually reacted very strongly to that. So as long as the health of the President of the United States remains pretty sound, and there's no uncertainty around that, markets will just take that in stride. However, if we do start to see a deterioration in the health of the President of the United States, then I do think markets will start to be a little bit more nervous, and how far they decline will really depend on how much uncertainty there is tied to that health situation.